When large institutions quietly accumulate an asset, it often says more than a price chart ever will. This week, ETF clients purchased just under $90 million worth in XRP, bringing the total amount of XRP held across ETFs to more than $723 million. For an asset that spent years stuck in regulatory uncertainty, this level of institutional interest sends a clear message: XRP is becoming part of the portfolios that matter. In today's deep dive, we're breaking down what's behind this surge in ETF demand, why institutions are pouring money into XRP right now, what this means for supply and liquidity, and the indicators that will help us understand where things go from here. And if you think real analysis like this deserves a spot in your feed, feel free to hit the like button. Before we're done, we'll also look at how ETF behavior can shape long-term value even when price doesn't move immediately. What the inflows tell us. The headline number, $89.65 million in new ETF inflows, is significant not only because of its size, but because of its timing. We're in a market where inflows have been uneven across cryptocurrencies, with some assets seeing outflows and hesitation. Yet XRP saw one of the strongest single-period allocations among altcoin ETFs. That kind of movement typically doesn't come from retail traders trying to catch a rally. It tends to come from institutions following allocation models or responding to structural changes in liquidity. Adding this latest inflow brings total ETF-held XRP assets to $723.05 million. This isn't just a milestone, it's a signal of how much exposure professional investors now have to XRP through regulated vehicles. A year ago, ETF-held XRP sat at a fraction of this level. The growth in assets under management has been steady, and the newest allocation reinforces that trajectory. What stands out is the consistency. While crypto can be volatile from week to week, institutional accumulation through ETFs tends to be more deliberate. These flows often reflect longer-term investment strategies, not short-term speculation. And whenever ETF-held assets pass a new threshold, it tells us demand is building through channels designed for stability rather than impulsive trading. But that's only the first layer. Understanding who is actually behind these purchases helps us take the next step toward making sense of this shift.
Who's buying through ETFs? ETF inflows come primarily from clients who want exposure to XRP without taking on the operational responsibilities of direct crypto ownership. These are typically institutional investors, advisory firms, wealth managers, pensions, and risk-managed funds. They're not looking for short-term price swings. They're looking for compliance-friendly ways to diversify portfolios. What makes ETFs appealing is that they remove the friction associated with crypto custody. Institutions don't have to grapple with private keys, wallets, or exchange risks. Instead, they can gain exposure through a product structured similarly to traditional equity or commodity ETFs. This familiarity goes a long way with compliance departments and risk committees, especially for organizations with strict investment mandates. ETF clients also tend to treat altcoin exposure as part of a broader allocation strategy. They don't typically chase momentum. Instead, they build positions slowly, often based on macro themes, long-term utility, or anticipated market developments. The nearly $90 million inflow into XRP reflects this kind of behavior: methodical, measured, and aligned with institutional patterns. But inflows don't happen in a vacuum. Institutions need a reason to build exposure, especially at size. And to understand what's driving them, we need to look at the conditions making XRP ETFs particularly attractive right now. Why XRP ETFs are seeing strong demand. Part of the appeal comes from the growing acceptance of crypto ETFs in general. Over the past year, ETFs have become the preferred entry point for institutions looking to gain exposure to digital assets. Regulatory clarity has improved, trading volumes have increased, and the overall structure of these funds has matured. XRP is benefiting directly from this shift. Another factor is XRP's core identity as a payments-oriented asset with high liquidity. Institutions often select assets that fit into long-term narratives. For XRP, that narrative revolves around global payments, settlement efficiency, and cross-border liquidity use cases. Whether investors believe XRP will fulfill all of that potential is less important than the fact that it offers a distinct profile within the digital asset landscape, something many altcoins do not. Demand may also be influenced by market conditions. When stocks and traditional credit markets go through periods of uncertainty, some investors diversify into alternative assets. Crypto ETFs, especially those with stronger liquidity, become natural candidates. XRP fits this need because it combines major asset liquidity with a narrative that's less tied to pure speculation. And finally, cost matters. Some XRP ETFs have competitive fee structures or lower friction than direct trading. When institutional desks compare direct crypto purchases with ETF exposure, the ETF route often wins. If you want more updates like this, feel free to subscribe. All of these factors contribute to inflows, but the effect of those inflows on the XRP market structure is an equally important part of the story. How ETF demand shapes market structure. Whenever ETFs accumulate a significant amount of an asset, they influence supply and liquidity in ways that aren't always visible at first glance. For one, ETF inflows can reduce the amount of XRP actively circulating in spot markets. Once ETF shares are created, the underlying tokens are typically held in custody for long periods depending on investor behavior. This can dampen volatility or reduce sell-side pressure during weaker periods. Institutional accumulation also tends to attract more participants, market makers, liquidity providers, and traders who adjust their models based on inflow patterns. As ETF-held supply grows, liquidity can deepen at key price levels, making the asset more appealing for large trades and improving execution quality. These structural improvements can have long-term effects. Over time, ETF-driven accumulation can shift the market from a speculative environment to one that behaves more like a maturing asset class. It's the same dynamic that occurred with gold ETFs years ago. Once institutions discovered a compliant, low-friction way to hold exposure, the market's character changed. But ETF inflows don't automatically lead to price increases, at least not in the short term. The relationship between flows and price is more complex.
Why inflows don't always move price immediately. One of the biggest misunderstandings in crypto is the expectation that large ETF inflows should cause immediate price appreciation. In reality, the impact is often gradual. That's because price is influenced not only by new demand, but also by existing holders selling into strength, traders taking profits, and broader market sentiment. In the case of XRP, inflows may offset selling pressure rather than overwhelm it. If retail sentiment is mixed, where speculative traders are reducing risk, ETF demand may simply help stabilize price instead of lifting it. This doesn't diminish the importance of inflows. It just means their influence plays out over time. Another factor is the size of the market. While $89.65 million is a meaningful amount for ETF inflows, XRP's overall market capitalization is much larger. To substantially move price, inflows must either become consistent or coincide with a period of low selling pressure. If either of those happens, the effect on price becomes more visible. Finally, ETFs create structural demand rather than impulsive demand. As institutions accumulate gradually, the long-term trend may strengthen, even if short-term action remains quiet. That's the role ETFs played in other asset classes, and crypto is beginning to show the same pattern. Still, institutions are not immune to risk. There are factors that could limit or reverse inflows, and understanding those risks is essential for a balanced outlook. Risks and possible disruptions. ETF concentration is one area worth monitoring. When a large portion of an asset becomes held by a small number of funds, it can create vulnerabilities. If sentiment shifts and redemptions rise, ETFs could release supply back into the market quickly. This isn't a current issue for XRP, but it's a factor to watch as ETF-held assets grow. Regulation is another consideration. Crypto ETFs operate at the intersection of securities law, commodities regulation, and digital asset policy. Changes in any of these areas could affect institutional access. While regulatory conditions have become more supportive, they remain subject to shifts in political or economic priorities. Market-wide risk is a constant variable. If macroeconomic events trigger risk-off sentiment, ETF inflows can slow, even if the asset's fundamentals are strong. Institutions tend to reduce exposure across all alternative assets during periods of stress, and XRP would not be immune. Finally, timing matters. Just as ETF inflows can build gradually, they can also cool gradually. What looks like the start of a trend may turn out to be a single allocation cycle. That's why monitoring follow-through is critical.
Isolated inflows matter less than consistent patterns. With these risks in mind, it's helpful to step back and consider what this institutional activity says about XRP's broader position within crypto.
Institutional adoption and XRP's position in crypto. The rise in ETF-held XRP reflects something larger than a single week's allocation. It underscores the broader institutional movement into crypto through regulated pathways. ETFs allow institutions to treat digital assets the way they treat traditional commodities or alternative holdings, making allocation easier and more standardized. This shift broadens crypto's reach. Instead of trading being dominated by retail speculation, ETF flows bring in longer-term capital with different objectives. They prioritize stability, compliance, and diversification over short-term excitement. When institutions allocate to an asset like XRP, they typically do so because it offers characteristics that complement their portfolios. XRP's appeal lies in its liquidity, its established track record, and its role in discussions around cross-border settlement. Regardless of whether investors believe every use case will be realized, the asset occupies a unique position within the crypto ecosystem, balancing high market capitalization with a narrative grounded in utility. As ETFs continue to expand, XRP's share of institutional portfolios is likely to grow. The current inflows may mark the beginning of a broader reallocation trend as institutions look for assets with liquidity depth and long-term relevance. But to understand whether this trend will continue, we need to watch a few key indicators. What to watch next? The most important indicator is whether inflows continue. One strong allocation can make headlines, but a sustained pattern tells us institutions are building exposure systematically. Daily and weekly flows will show whether this demand becomes a trend or remains an isolated event. Tracking total ETF-held XRP assets is equally important. Crossing $723 million is meaningful, but the question is whether that number moves towards $800 million, $900 million, or even higher. Each threshold offers insight into institutional appetite and allocation cycles. Price relative to inflows is another measure. If inflows grow but price remains flat, it may indicate ongoing selling pressure or broader market weakness. If price begins to move in tandem with inflows, that can signal supply tightening. Finally, macro conditions matter. Institutional flows are sensitive to interest rates, liquidity expectations, and market volatility. Any major shift in these areas could influence how ETF clients allocate to crypto. But watching these factors together, we get a clearer sense of whether this week's surge reflects a lasting shift or a shorter-term rebalancing. Institutional investors just purchased nearly $90 million worth of XRP, bringing ETF-held net assets past $723 million. This isn't a minor development. It marks a deepening connection between XRP and the world of regulated long-term investment vehicles. While inflows don't guarantee immediate price movement, they shape the foundation of XRP's market structure and influence how the asset behaves over time. Whether this becomes a defining moment depends on what happens next, whether inflows persist, whether institutions continue building exposure, and how the broader market responds. But one thing is clear, XRP is earning a larger role in portfolios that didn't include it before. If you want more institutional level updates like this, feel free to subscribe and share your thoughts in the comments. Your perspective helps guide where we take these conversations next.